We're pretty close to fair value. If I take our models at face value, we're still a few dollars below fair value. The reason is that inventory levels are now somewhat below the historical average. And what's interesting about the rally in oil prices is that usually if you were concerned about disruption risk, you would expect the spot front contracts to rise the most. But we have sort of seen a parallel shift upwards in the oil futures curve, suggesting that the market is potentially also pricing a probability of persistent disruptions. Perhaps the market is putting a meaningful weight on a potential tightening in secondary sanctions for Iran for a long time.
Let me ask you about what kind of disruption we might see in Iran. Picking up on what Guy was asking there, this is what everyone is watching for. Is what we're in this sort of cycle of retaliatory attacks and waiting to see what happens there. And poring over maps of Iran and looking at all of the energy infrastructure. I mean, on that map we see oil, we see gas, we see refiners, we see pipelines, we see port facilities. Give us a sense of where disruption would be more significant and where it would be less so.
In terms of the significance for crude oil prices, I think that potential damage to the large export terminals would be more significant than the potential impact on crude field production. And I think the smallest impact would be if you were to see damage to refining assets. Export terminals are highly concentrated, and so that poses some vulnerability. If I look at fields production, it's fairly spread over a large number of fields, except one large offshore field that is shared with Qatar, which may potentially reduce the incentives for any damage.
Yeah. And if we did see it targeted, so we did see Iranian infrastructure on the energy side targeted, then people start to ask questions about whether there is then an Iranian impulse to shut off the Straits of Hormuz or to interfere with that in some way. What are you thinking? What are you hearing within the industry? Because obviously that brings into play the ability to get out other countries' supplies. Supplies that do go very directly into Western markets.
Yes, so clients are very focused on the tail risk of potential interruptions of trade of energy products through the Strait of Hormuz. That concern is very understandable given the fact that roughly 1/5 of global oil supply is coming through that strait. And even if the probability is very low, even if this is very much a tail scenario, it's an important scenario because the main reason why oil prices have not responded very significantly to ongoing wars over the last couple of years is that there is a lot of spare capacity, about 6 million barrels per day, which suggests that if you were to see tightening shocks in most geopolitical tightening scenarios, spare capacity from countries like Saudi Arabia and the UAE would allow to offset these tightening effects. But that, of course, assumes that these countries can get the oil out. And so even if this is a low probability tail scenario, I think investors' focus on the scenarios is a very logical one.
Thinking about oil markets and how they might be disrupted by what might happen in the Middle East, carry on the analysis from, if we do see some... you mentioned refineries, that would be of all the things that could be targeted, that would have a lesser impact. What about the impact of military action in Iran and what it does to refined products, the prices of refined products? Because reading your notes, it was quite a bit more complicated than just, oil prices will go higher, therefore the prices of all the refined products will go higher as well. Talk to us about some of that complexity.
Yes, so I think the most important impact on refined product prices from potentially damage to infrastructure in the oil sector in Iran would be higher crude prices, even if the impact on the refining margins is somewhat ambiguous. So we're more focused on the impact on crude prices.